New superannuation changes come into effect from 1 July this year, and today I'm meeting with James O'Halloran, Deputy Commissioner, Superannuation from the Australian Taxation Office, to go through some of those changes, to consider how you might be able to help your clients familiarise yourself with those changes. Thanks, James, for coming and welcome.
Look, thanks, Paul. It's a pleasure to be here to share some thoughts with you and your members.
Now, James, there's a shrinking window, a transitional period between now and year end, and there's quite a lot of superannuation changes that we need to consider.
Look, there are, but equally, I think if we approach it methodically and unpack a few things today, we can assist your members and also clarify any points for follow-up.
Well, we know that tax professionals have been busy talking to their clients and brushing up on these changes, but what should tax practitioners be doing in this transition? What should they be doing now, even though some of the measures don't come into effect until 1 July 2017?
Yeah, look, probably like many things, the first thing is that the members and others listening to this video need to understand the changes themselves. They then need to, in fact, probably identify from their clients and of their clients which ones on first examination seem to be directly affected, and to some degree probably also assisting some of their clients who perhaps think they're affected, because we recognise that people need to be very clear, and that's where the expertise of your members can come in to help them understand what they need to do, particularly prior to 1 July. That's particularly important at the moment. So agents need to look at their clients' salary arrangements and consider whether existing salary sacrifice arrangements will exceed or in fact come close to exceeding the reduced concessional contribution cap of $25,000. Now, they also need to consider if their clients can make additional non-concessional contributions before the non-concessional contributions cap is reduced. Now, other things is they need to take into account that some clients may in fact be able to take advantage of the increased income thresholds for the spouse tax offset after July 2017. However, you also need to consider that if they can claim a personal superannuation contribution deduction, and if so, whether they have lodged the necessary paperwork. Now, of course, it's important to remember that valid personal super contribution deductions count towards a client's concessional cap.
So, James, what specifically needs to be considered before 1 July 2017?
Well, there's a number of things, perhaps if I break them down. The first thing is to consider is shifting retirement phase benefits to accumulation to prepare for the transfer balance cap. Now, why this is important is the new transfer balance cap introduces a lifetime cap starting at 1.6 million. Now, this is on the amount an individual can transfer into retirement phase to start an income stream with. Also, the cap takes into account income streams that people may start to receive, such as death benefits. Importantly, the consequences for exceeding the cap will depend on the type of income stream that takes your client over the cap. For most people with account-based pensions and annuities, they'll need to remove the excess capital. For some people who exceed their cap because of an income streams that can't generally be commuted, which are known as capped defined benefit income streams, taxation of their income stream will change once they are 60 years of age. Now, Paul, if your client's SMSF uses the segregated method and transfers assets out of its segregated pension asset pool before 1 July 2017, CGT relief can apply on the date of transfer. Now, Paul, the SMSF will be eligible for relief if it used the segregated method through the period from 9 November 2016 to 30 June 2017, holds the asset throughout that period, and it needs to take action to prepare for the transfer balance cap, or changes to the treatment of transition to retirement income streams, sometimes known as TTRs or TRIs. Now, of course, there are still a few things that I think your members should take into account. Now, if relief is applied, the asset's cost base is reset to its market value at the time of transfer. Any capital gain or loss is entirely disregarded. Now, further, the SMSF will need to hold the asset for at least 12 months after its time to qualify for the CGT discount, and the indexation method will no longer be available for an asset originally acquired before 21 September 1999. Now, the SMSF should also clearly document the date the assets cease to be segregated current pension assets.
James, another important thing for SMSFs is about the segregated and proportional method for CGT relief and for assets. Can you tell us a bit about that?
Yeah, look, there's clearly been a lot of discussion about that. So yes, you're right, SMS will also need to consider whether they should switch from the segregated method to the proportional method and apply CGT relief. Now, instead of transferring specific assets to the accumulation phase, the SMSF may switch to the proportionate method. Now, an example is where the SMSF has large assets with high market values, but its members only need to commute a small amount back to the accumulation phase. So in this case, the SMSF's assets that were segregated cease to be segregated on the day they switch methods. The SMSF can apply CGT relief to some or all of these assets to reset their cost basis to their market value at that time. And again, as I mentioned earlier, the SMSF will need to hold the asset for at least 12 months after this time to qualify for the CGT discount. And the indexation method will no longer be available for assets, as I said earlier, originally acquired before 21 September 1999. Now, as the SMSF will start to have assets that support both accumulation and retirement phase interests, they'll need to obtain an actuarial certificate to support the use of the proportionate method.
So James, claiming CGT relief is another important element of this. Can you talk us through that, please?
So look, you're right, claiming CGT relief is important and it does need to be considered. Now, why it's important is to remember that CGT relief is not automatic. CGT relief is claimed in the CGT schedule to the fund tax return. All trustees that want to claim CGT relief need to complete this schedule. Of course, as importantly, a choice to apply the CGT relief cannot be revoked and must be made on or before the day you are required to lodge your 2016-17 income tax return. And as always, you need to keep appropriate records for each asset subject to the CGT relief and any deferred tax liability in accordance with your record keeping requirements. So it's important to remember that the ATO, as you would expect, will monitor any appearance where trustees are using a short-term, perhaps contrived strategy, such as starting a pension for a few days and then moving back to the accumulation phase to gain access to the CGT relief provisions. So probably a final thing to consider is in fact the valuations. SMSF asset valuation guidelines are available on the ATO website. Now, these will help value members' interests for total superannuation balance and transfer balance cap. So SMSFs can rely on these guidelines in order to comply with their super reforms. But please remember that your valuations do need to be consistent, and we will be monitoring for inconsistencies between valuations used in applying CGT relief and those used for transfer balance cap.
That's great, James, and very informative. But what if I have an SMSF client who, due to a contribution, no longer has segregated assets and they made that contribution after the 9th of November 2016?
So look, CGT relief may be available where the fund switches from the segregated method to the proportionate method, provided it's at some point between 9 November 2016 and 30 June 2017. Of course, provided the fund needs to take action or is affected by the transfer balance cap or changes to the TRIS. Now, Paul, the relief allows an SMSF to choose to reset the cost base of certain assets actually held by the SMSF on 9 November 2016, and they continue to hold until 1 July 2017. Now, importantly, the relief does not apply to new assets acquired since this date.
James, many of our members and the tax profession more broadly and their clients are very interested in what options are available to them to enable them to contribute to their super before 1 July 2017. Perhaps you could talk about some of those options.
Clients, of course, may not want to consider making concessional contributions before the reduction in the concessional cap. So just to be clear, from 1 July 2017, the concessional cap contribution is $25,000 for everyone. So look, previously it was $35,000 for people 49 years and older at the end of the previous financial year, and $30,000 for everyone else. So as you asked, Paul, if you want to make additional contributions to take advantage of the higher cap, you'll need to do a couple of things. Firstly, check what concessional contributions have been made to all your super funds or your clients' super funds from 1 July 2016. So then, on behalf of your client, estimate the amount of employer contributions that will be made before 30 June 2017 and how much are contributing or being contributed through salary sacrifice. You can use the Estimate My Super tool, which is available on the ATO website, to assist you. Now, it can also be arranged for the additional concessional contributions up to the age cap to be paid to the superannuation account before 30 June 2017.
James, individuals should also be considering their non-concessional caps in the transition and the lead up to 1 July 2017.
Look, that is right. People should consider the non-concessional cap opportunities. Just to be clear again, after 1 July 2017 in this instance, if you have a super balance of 1.6 million or more, you'll not be able to make further after-tax contributions. However, before 30 June 2017, you can still make an after-tax contribution. The change is that from 1 July 2017, the annual non-concessional contribution cap will be reduced from $180,000 to $100,000 per year. Now, this will remain available to individuals aged between 65 and 74 years old if they meet the work test. Now, you should note that the new non-concessional contributions cap is set at 4 times the concessional contributions cap and will increase in line with the indexation of the concessional contributions cap. Now, there's also a few key things to keep in mind as well if you want to make extra non-concessional contributions. So make sure you do not exceed your annual non-concessional contributions cap of $180,000 unless you intend to trigger the bring forward rules. Now, by that I mean you can contribute up to your annual non-concessional cap amount, including any bring forward of caps you have not used. For example, you may be able to contribute up to $540,000 before the cap changes and the new bring forward arrangements take effect. You should check any requirements that are appropriate for your client's age, and if you plan to use a bring forward arrangement, you need to ensure that your client has not already triggered the bring forward rules in the last 2 years. So make sure your contribution or the contribution is paid to the superannuation fund and received by them before 30 June 2017.
So James, what do our clients need to do from 1 July 2017 this year?
So look, Paul, that date is important. In my view, there's 4 key things that clients need to consider, and therefore I'd encourage advisors to be aware of. Firstly, it includes considering the individual transfer balance cap and if your client is retired or retiring after 1 July. Now, each individual has their own transfer balance cap and transfer balance account, so it can't be shared or combined with anyone else. Now, while the transfer balance cap is 1.6 million for each member of a couple, it cannot be shared or aggregated between a couple. So, for example, one member of a couple cannot have 3 million in retirement phase, while the other member has $200,000 in the retirement phase. Now, the ATO will calculate the transfer balance account across all your clients' retirement phase superannuation interests, which are provided by all funds and the life insurance companies. So remember the consequences if your client exceeds the transfer balance cap. Now, most people who have an excess balance will need to remove the excess along with their daily compounding notional earnings on the excess. You must, or your client must, commute the excess amount and notional earnings, as you cannot fix the excess by making a large pension payment. Now, your client will be liable to pay excess transfer balance tax on the notional earnings accrued until you reduce the balance below the cap. The tax rate will be 15% in 2017-18, and then after that 15% for a first breach and 30% for a subsequent breach. Now, you should note, of course, that if your client exceeds the cap because of a capped defined benefit income stream, instead of being required to commute an excess, the tax treatment of that pension will change and your client may need to pay more tax. Now, there will be a lower non-concessional contribution and the concessional contributions from 1 July 2017. It's important to remember that concessional contributions will be capped at $25,000 for all ages, while non-concessional contributions will be $100,000. Your client's total superannuation balance will affect the eligibility for a number of measures. Each individual will have a total superannuation balance which represents all of their superannuation interests at a point in time, including those in the retirement phase and the accumulation phase. Now, this balance will impact on the individual's ability to contribute to superannuation, since it will affect their non-concessional contribution cap, including access to the bring forward rules, and their ability to make extra concessional contributions by carrying forward unused concessional contributions cap after 1 July 2018. Now, the balance will also affect your client's eligibility for government co-contributions and the offset for spouse contributions. For a client with an SMSF, the balance may also affect which method the SMSF uses to calculate its earnings tax exemption.
James, we've also had a number of questions about transition to retirement income streams. So what do those that have transition to retirement income streams, or TRISs, actually have to do now?
Yeah, so Paul, we've also had a number of questions about that. So those who are transitioning to retirement may need to consider their strategy. This includes choosing to cease or continue the TRIS. The first thing to consider is if you or your client want to cease or continue a transition to retirement pension. Now, you can still commence or continue a TRIS after 1 July 2017 if you have met the preservation age. But what you need to remember is, regardless of whether a TRIS started before 1 July 2017 or after, the earnings from the assets supporting a TRIS won't be tax-free. They'll be taxed at 15%. You may also choose to cease a TRIS and commute to accumulation phase before 1 July 2017, and CGT relief may be available for the fund. Now, CGT relief may also be available if you continue a TRIS beyond 1 July 2017 and the assets lose their eligibility for tax-exempt earnings.
Now, James, do you have some key points that you would like to impress upon SMSF funds today?
So look, I do have a couple. Firstly, you need to be aware that all the new caps and how they apply to your clients' situations are important. If clients have more than 1.6 million in retirement phase, they will need to take action before 1 July 2017. Secondly, if an SMSF wants to apply CGT relief, they need to ensure that they make that choice in the CGT schedule to the 2016-17 fund tax return, and that they lodge it on time. The relief will be valid where there is a formal extension of time for lodgement that is met. Remember though that if a fund failed to lodge on time for 2015-16, their lodgement date for 2016-17 will be brought forward to 31 October 2017. Now finally, there are real benefits for members where SMSFs are able to undertake asset valuations and reporting as early as possible. The SMSF will have a better and earlier understanding of their situation and how the superannuation changes affect the SMSF and its members. It also means that the ATO's services and tools can be more up to date, and members would have greater certainty and comfort when using our tools.
So just on that point, James, about tools and services, I mean, it's fair to say that these super changes, they're quite complex. They're the largest changes we've had in the last decade. What are some of the guidance notes and products that the ATO have been rolling out to assist both our members and the tax profession and their clients to get across all of these superannuation changes?
So you're right, Paul, there is significant changes, and it is important that the ATO provides certainty, and we have been seeking to develop and have deployed a range of resources to help tax agents and professionals prepare for these changes. Now, some of these include the ATO website itself. Now, that has information about all these changes. The website also has a range of what we've termed guidance notes to help explain what these changes are and what people need to do before and after 1 July 2017. Very importantly, I think, we've also finalised a range of law companion guidelines to explain how the law works from the ATO's perspective. We'll also continue to run a series of webinars to cover a range of topics regarding the upcoming changes for the industry. And in the lead up to the changes, we'll also be releasing reporting guidelines for advisors and the industry.
James, look, thanks again for your time today to answer the questions that our members have been raising, questions that the ATO has been receiving as well. And you've just articulated a whole bunch of guidance notes and further information that's available to the public in the public domain. But what is the best place to go to access this information?
So thanks, Paul, for having me here today. In answer to your question, the best place to receive more information on the changes is the ATO website, ato.gov.au/super changes. And there you'll find the guidance material I referenced, law companion guidelines and other resources to help you, your members and their clients to prepare for the changes ahead.
Thanks, James.